Hi, in this video I'm going to cover adjusting entries and specifically the accruals types of adjusting entries. Accruals fall into two main categories, accrued revenues and accrued expenses. In accrued revenues, we've earned the revenue but we haven't yet received the cash, and in accrued expenses, we've incurred some sort of expense but we haven't yet paid for it. So let's look at an accrued revenue. And you're actually already familiar with accrued revenues. You've actually already done them. They just haven't quite called them accrued revenues for you. So here we have Pioneer Advertising. They perform services worth $200 that were not yet billed to clients in October. So at the end of the month, they go through, they look at all of the activity they've had, and they say, okay, we still have to bill customers for $200 worth of services. So on October 31, they need to do an adjusting entry for that, even though the payment's not going to be received until a later period. So on October 31, the adjusting entry is a debit to accounts receivable and a credit to service revenue. Now let's look at a type of accrued expense, which is interest expense. So Pioneer Advertising signed a 3-month note payable in the amount of $5,000 on October 1. It has an annual rate of 12%. So first we need to calculate the interest that's built up in October, because even though we don't have to pay it until the end of the 3 months, that expense has been incurred, and so we need to record that at the end of October to make our financial statements accurate. Okay, so our interest rates are always presented as annual rates. It doesn't matter what the length of the note is, which in this case is only 3 months. Our interest rate is an annual rate of 12%. So we need to multiply our rate times the amount of time that's gone by in terms of 1 year. And so in this case, only 1 month has gone by, right? We signed on October 1, now it's October 31. So we're going to multiply the 12% by 1/12. If we were doing it for 3 months at a time, we would multiply it times 3/12 if we were recording it for the full quarter. So in this case, we took the 5,000 times 12% times 1/12, and that equals $50. So our amount of interest that accrued during October is $50. Therefore, on October 31st, our adjusting entry would be a debit to interest expense and a credit to interest payable. And they would do the same entry for the $50 at the end of November and at the end of December, and then they would pay it right on December 31. Let's look at accrued salaries, right? You know that you work during the week, but you don't actually get paid at the end of every day that you work. You usually get paid every 2 weeks or maybe twice a month, depending on what your employer does. So your employer has to record the accrued salaries for what you've worked, but you haven't been paid. So here we have Pioneer. They last paid salaries and wages on October 26th. The next payment is not going to occur until November 9th. So people are paid up through the 26th. But they worked these Monday, Tuesday, and Wednesday of October, the 29th through 31st. And so at the end of October, we need to record those 3 days worth of salaries that have been accrued or built up, even though we're not paying them until November 9th. So it tells us that the employees received total salaries of $2,000 for 5 days. So then we can assume that for 3 out of the 5 days, the accrued salaries would be $1,200. Then our adjusting entry on October 31 would be a debit to salaries and wages expense of $400 and a credit to salaries and wages payable of $400. Note it's just the $400, just the 3 days in October that they worked, but we haven't paid them. Because everything prior to that point, the 26th and previous, we've already recorded and paid, so we don't need to worry about those days. We're just trying to catch these last 3. Okay, now we have gone through our accrual types of adjusting entries, and you'll notice that in our accruals, the revenue or expense is recognized in the first period, and that's when we do the adjusting entry, even though the cash is going to be received or paid in a later period. So I hope this video helped you understand the accruals. Be sure to check out my other videos on why we do adjusting entries and the deferrals type of adjusting entries. Thank you.